This content is provided for informational purposes only and should not be relied upon as legal, business, or tax advice. All opinions expressed are opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. This is recorded Monday, January 18th. Matt Bradbard here from RCM. My intention is to record these short videos every few weeks or when relevant developments come from China. The goal is to provide more color from my perspective and explore different ways to access the marketplace. This is my third Enter the Dragon update and first post in 2021. Each recording covers a few overarching topics. Number one, an update on RCM's China business. RCM's current relationships were providing market signals to 165 million RMB and have 10 strategies running through 4 different onshore groups. RCM is in discussion with an existing MOM structure about a larger JV relationship, and also we are in dialogue with a newer capital source on both an MOM and PFM fund collaboration. Our goal has always been to build out distribution for those Western strategies that exhibit the best alpha opportunities. Not unlike the US, an attempt to identify CTAs that have robust infrastructure, have the ability to manage risk, and can harvest alpha. Our objective is to get 1, if not 2, of the current SIM strategies live ahead of the Chinese New Year and continue to add RMB to strategies that are live. The goal remains to punch through 200 to 250 million RMB level in AUM in early Q2. The positive news is we've seen interest pick up in recent months from several Chinese capital sources. In the second section, I generally touch on volume and what markets are moving. I'm going to do something a bit different in this section, pointing out the largest advancers and decliners in China in 2020. The largest winners in 2020 all come in at about 50% appreciation. Soybeans up by just better than 50%. Iron ore up by just better than 53%. And then coke appreciating just shy of 51%. The 3 largest losers in China in 2020 are bitumen, down 21%, PTA, down 23 and change, and then INE crude oil, our biggest loser, down over 36% in 2020. Of the 45-ish Chinese futures markets that I track, 8 traded lower, while the lion's share appreciated year over year. In the third section, I touch on any new developments. RCM is in several conversations in recent weeks, verifying the best path forward for investors and traders alike to trade the 7 international markets with either Hong Kong or Singapore domiciled custodians. RCM is getting closer to a solution and feel that we could facilitate trading ahead of the Chinese New Year for a select few interested parties. Again, as a reminder, those 7 markets are PTA, iron ore, INE crude, low sulfur fuel oil, natural rubber, copper, and palm oil. In another recent development, the Dalian Commodity Exchange on January 8th launched a hog futures contract in the hope to improve the pricing mechanism for hogs as well as pork, a staple meat in China. Trust me, they eat a lot of pork in China, from the tutor to the rooter. Very little goes to waste. In the fourth section, what does the future hold and how is RCM going to add value? Big picture, the story remains the same. 2-way flow, east to west and west to east for both investors and traders. RCM will continue to throw logs on the fire, adding AUM to Western CTAs trading China as alluded to. But I believe the real opportunity that provides the best growth will come from Western investors putting money to work in China. And I view this in 3 phases. Number 1, trading the 7 internationalized markets. Number 2, trading the 15 to 25 QFII approved markets. And rumors are that we should get more clarity in the coming weeks on what those markets will be. And then number 3, the full Monty, trading direct via swap or some type of vehicle that allows access to all 45 markets. Wrapping up, please get in touch if you have any questions or if you'd like to get more information or if you have specific topics on China content that you'd want covered on future recordings. I conclude this with a question that an informed pension fund has been asking me and CTAs. Why is China a better opportunity than the US? Why do trend followers show a marketable improvement applying the same or similar models to China futures versus US futures? Please reach out to me if you have an opinion, or even better, if you have quantifiable evidence. Thank you.